welcome back to another tutorial session with Grand Majors Academic Support Services. Today we're looking at marginal costing, and just to give you some brief information on what marginal costing is. So marginal costing is an internal decision-making tool used by management, right? It has two main features. The first one being that it separates all costs into fixed and variable costs. So as you would have learned in our prior videos, right, where we're looking at the cost of an item, and that includes what? The product cost of an item is your direct material plus your direct labor plus your overheads, right? So in doing marginal costing, you're separating all those into fixed and variable costing. And or fixed costs are considered period costs and are expensed in the period they incur, right? The second element of marginal costing is that it calculates what we call contribution. And contribution is calculated, the formula for that is sales revenue minus total variable costs, right? So this is the reason why we separate all our costs into total fixed and variable costs. Two other points under marginal costing that I want you guys to be mindful of is that marginal costing, it's repeating it, but marginal costing assigns only total variable manufacturing overheads to products. So you know, to find your product cost is your direct materials, your direct labor, and your overheads. However, if you're doing marginal costing, the marginal cost per unit is going to be direct materials plus direct labor plus variable manufacturing overhead. So we're not taking into consideration the fixed portion when doing marginal costing. That is assigned elsewhere. And we'll take a greater look at that as we go on and as we do our question to come. So in front of you, you have your marginal costing statement. Hearing the topic marginal costing, you'll usually be required to produce a statement, right? And it does look like an ordinary income statement. However, it's a little bit different, right? We say in marginal costing, one of the main features is that we calculate contribution. So what is synonymous to contribution here in a regular income statement would be gross profit, right? You would still have your sales revenue. After sales revenue in a regular income statement, you would subtract cost of goods sold. It's the same here. However, it's just variable cost of goods sold, because how do we find contribution? It's our sales revenue minus our total variable cost or total variable cost of goods sold and any other variable cost that we might have. The sum of those gives us contribution. Then from contribution, right, we subtract all our fixed costs or total fixed costs, that's TFC. And that includes the fixed manufacturing overhead and any other fixed costs, right? The sum of that or the calculation of that then gives you operating income. So let's look at a question, right? It says, it's one question to here, but it's question one. So the data, the 2006-2020 X6 data that follow pertains to Rays, a manufacturer of swimming goggles. Rays had no beginning inventories in January 20X6. So we have a table, we have selling price, and selling price is how much you sell the goods for, right? Then you have variable manufacturing expense per unit. You have sales commission expense per unit. And here we can say, okay, sales commission, it's a variable cost because it's per unit, and sales commission, when you get a commission, it's usually based on what you would have sold, right? Or sold to anyone. So this varies directly and proportionately with how much goods you sell. So we're saying our sales commission here is a variable cost and it's per unit, right? Then we have fixed manufacturing overheads, $2 million. So this is a fixed cost, and we're saying fixed manufacturing overheads, whether you make 2 goods or 100 goods, your fixed manufacturing overhead is always going to be the same. Remember what we said, fixed costs they don't vary in terms of how many goods you produced, right? And as I said before, if you produce 2 goods or if you produce 2,000, the fixed cost would be whatever it is. And in this case, it's 2 million. Your fixed operating expense is $250,000. Here it also tells us that we produced 200,000 goggles and we sold 185,000. So the requirement here is to find total cost per unit. Then it says find the value of ending inventory using marginal costing and the value of ending inventory using total costing. So yes, we are doing marginal costing. And I gave you some information about what marginal costing is. But what is total costing? Total costing is what we would have known, where you have your direct materials, your overheads, and the labor. And these includes both the fixed and the variable portion of our goods. So if we want to make a comparison between marginal costing and total costing, it lies within how variable manufacturing overhead is treated. In marginal cost, in how fixed, manufacturing overhead is treated. So let me repeat that. The difference between marginal costing and total costing lies in how fixed manufacturing overheads are treated. So remember before we said marginal costing, right? The fixed portion, it's not there to find marginal costing per unit. It's direct materials, direct labor, plus your variable manufacturing overheads. In total costing, it's direct materials, direct labor, plus your fixed and your variable manufacturing overhead. So that in essence is just total overheads in general, all right? So let's look at both. So we need to find total cost per unit, and our cost per unit, that's gonna include both the fixed portion and the variable portion. So scanning through the data, we can easily identify the variable portion of it. So variable manufacturing expense per unit is $15, right? But we need to find total cost, so we need to find the fixed portion. So here in the question, we do not have fixed portion per unit. We have total fixed manufacturing overhead, right, which is $2 million, right? And what do we also know? We also know how many goggles did we produce. We know that we produced 200,000 goggles. So to find the fixed portion of that, all we have to do is to divide 2 million by 200,000, right? We could have gotten the same information for variable manufacturing expense. What if they had given us the total cost? We could have found the per unit figure. So here for the fixed manufacturing overhead, to find the fixed portion, we're gonna have to divide the 2 million by the 200,000, we would have gotten 10. So to find total cost per unit, total manufacturing cost, we're gonna add that 10 plus or $15 for variable manufacturing expense per unit, and our total cost per unit is $25. The next part of the question tells us the value ending inventory. So nowhere here tells us what was our ending inventory. Right, so they didn't explicitly say this is what we have left. However, we can use our formula that you're seeing here, right? And the formula that we know, and you're seeing the full question, but we'll go through it, right? The formula that we know in terms of production cost is beginning units plus production minus ending equal units sold. If we're supposed to go back to the question, right, we would have had all information here relating to this formula except the ending inventory or the ending unit. So therefore, we can make ending unit the subject of the formula. And by a process of transposition and, we can find it. So here, to make ending units the subject of the formula, it will now read beginning units plus production minus units sold give us ending unit. So our beginning unit was 0. It told us that at the beginning. How much did we produce? 200,000. How much did we sell? 185,000. So the answer for that is 15,000. So what we know is that we have 15,000 goggles in ending inventory. Right now we need to put a value to that, right? A total dollar figure to that using both marginal costing and total costing. So looking at it from marginal costing, right? It's the 15,000 goggles times what's marginal costing per unit? It's $15 because marginal costing only assign the variable manufacturing costs to it. And in the previous part of the question, when we calculated total manufacturing cost, it was the 15 for variable and the 10 for fixed. So in marginal costing, we're only taking that variable portion, which is 15. So our ending inventory on the marginal costing is 225,000. And our ending inventory for total costing, it's the same 15,000 units that is left. However, this time we're multiplying by 25 because total costing per unit is the variable portion and the fixed portion, and that was $25. So our ending inventory, valuing it using total cost, right, is 375,000. So we're seeing here, if we're supposed to make a comparison, the value of our ending inventory is far more greater using total costing than marginal costing. So we would have done part A of the question. Part B states to prepare the variable costing contribution margin income statement for RAISE for the year ended December 31st, 20x6. And we would have seen what that looked like in the beginning of our question. So, as per usual, whatever statement you're doing in accounting, you need to have your heading. And your heading includes the name of the company. In this case, it's RAISE. The statement that we're doing the marginal costing statement and the period. And the period for which we're doing this is for the year ended December 31st, 20x6, right? The first thing that we start with is your sales revenue. And we sold 185,000 goggles at a selling price of $35. That gives us a total of 6,475,000. Remember, we're doing the marginal costing statement. So following that, we're subtracting total variable costs, right? So it's going to be variable cost of goods sold. How we find that? We know that our variable cost per unit is $15 and it's cost of goods sold. So it's going to be that multiplied by the amount of goods that we sold. And we sold 185,000. So we multiply that and we get 2,775,000. What other variable costs do we have? Remember, we had our sales commission, and we did say from the get-go that our sales commission is a variable cost, right? And it varies with the quantity of goods that is sold. So it's $5 per unit, and we sold 185,000 goggles. So we multiply that and we get 925,000. We sum both because those are our total variable costs. There were no other variable costs from the table, right? And we get a total of $3.7 million. Subtracting that from our sales revenue, we have a contribution of $2,775,000, right? So our contribution is our sales revenue minus our total variable cost, right? So from our contribution, we can now subtract our total fixed costs. And our fixed costs includes the fixed manufacturing part of it, which was the $2 million, and our fixed operating expense of $250,000. we've done both, and we'd have gotten 2,250,000. Then when we subtract this from our contribution, we have an operating income of $525,000. What I'm going to advise you is, so I'm going to encourage you to note this figure. Our operating income here is $525,000, right? So we would have answered part B. Part C says, Ray's marketing vice president, right? He believes a new sales promotion that costs $150,000 would increase sales to 200,000, right? It would increase it to 200,000 goggles. So if you partake in this promotion, if you do a little bit more ads or have person going on the street to give out pamphlets or whatever the promotion is, the marketing tactic is, it's gonna cost you $150,000. And in doing so, right, your sales would increase to 200,000 goggles. Your sales was previously 185. So the question that they're asking is, should you go ahead? Should you advise the company to go ahead with the promotion, and why? Give your reasons. So let's look at how this looks mathematically, right? So we're going to redo the statement, the marginal costing statement, and we're now going to change the values. So if we do this marketing promotion, it's going to increase the quantity to 200,000. So our sales revenue is going to be 200,000. Our selling price remains the same, times $35, and that's $7 million. Now our total variable cost that we're going to subtract, that would also increase, right? So your variable cost of goods sold is now 200,000 units, right? Multiplied by 15, that gives us 3 million. And our commission also increased. It's now 200,000 units that you're selling times $5. That's $1 million. Remember, also, we now have to factor in this sales promotion, right? It's $150,000. So here, our total variable cost is 4,150,000, right? We subtract that from our sales revenue, and we have a contribution of 2,850,000. So here we're seeing, okay, our revenues increase, and despite having an additional cost on top of increasing variable costs, because our revenue increased, our variable costs also increased, and we also took on an additional cost, 150,000. Despite all this, our contribution increased. Our contribution now is 2.85, Our contribution before was 2,775,000. Not only that, after we would have subtracted our fixed costs, and our fixed costs remain the same. This drives out the point where we say, it doesn't matter how many goods we sell, right? Remember, when we sold 185,000 units, our fixed cost was the same, 2,250,000. Now, given this scenario, if we sell 200,000 goggles, our fixed cost is the same, right? So subtracting that from our contribution, we have an operating income of 600,000. What was our operating revenue before? 525. So we're saying, whoa, despite all this, despite the additional sales promotion cost of $150,000, right? And the increase in variable cost of goods sold and commission, we still managed to increase revenue. So what would you advise them? Yes, go ahead, do this promotion. Yes, it will cost you to incur an additional cost of the sales promotion figure. And yes, it will increase your variable cost, but it also increased revenue so significantly that it outweighs all of that. And you're now having an increase in your operating income. right? So that would be my advice to the company. And that is also the ending of today's question, right? Remember, as per usual, to like this video, share it with anyone who you think might find it useful. Subscribe to our channel to keep the family growing and to keep our community growing. And most importantly, if you have any questions, remember to tell us in our comments. So we'll see you next time for another question.